Hey, welcome back to Subject to Change, a personal finance podcast where we answer your personal finance questions. My name is Nick.
And I'm Chris. And today we have a question coming to us from Reddit, from Undercooked Broccoli, the name. And the question is, what's the best thing to do with $20,000 before we buy our house? My girlfriend and I run a business. We have around $20,000 saved to buy our house next summer. I feel as though the money, if it just sat in our savings account, would only get about 0.10 to 0.15% in interest. There must be a better method for storing this money before we need to use it, so that it generates a better return. We have about a year. So what do you think, Nick?
Okay, so they've got a lump sum of cash, and it's sitting in a savings account right now. Mm-hmm. I'm not super familiar with the interest rates that come with savings accounts, but I know like savings accounts compared to checking accounts, they offer you an interest rate for keeping your money in there, and then that comes with some like restrictions. You can't withdraw a ton of money all at once, or you're limited to the number of transactions you can make, and they reward you for that with an interest rate. So I don't know what a competitive interest rate is, but that sounds a little low, what they've got right now. Mm-hmm. And then I also know that there are other, I don't know if they're investments or investment vehicles that you can get at a bank, things like a CD,
right,
that may offer a higher interest rate, but I don't know how long you have to keep your money in there. I mean, I feel like I empathize with this person because I've been in similar situations knowing I want to buy a car or something, and I have a lump sum of cash, and it just feels silly that it's sitting there for a year until I'm ready to pull the trigger, but I don't know what options are out there. What do you got, Chris?
Yeah, I think with money, it keeps coming back to, as we answer these questions, risk versus reward. Mm-hmm. Always. The more you're willing to risk, the bigger the reward. The least you're willing to risk, the least of the reward. And so risk comes in a multitude of fashions. One is the amount of money that you have to risk. So the more money you have, the better return that you can get because you're giving more up versus having a smaller amount. So $20,000 is a lot of money, but it's not a considerable amount of money. So you're probably not going to get a lot of special deals at your bank because you have $20,000 to invest. You're probably just going to get the standard thing that they're offering. The second thing is time, right? So the more time I put my money up, the more risk I'm taking on. The less time, the less risk. And so a year really isn't that much time either. When you think of the Treasury has 90-day Treasury bonds. They have 1 year, 3 year, 10 year, 20 year, 30 year. So you can have long-term bonds that are out there, long-term investments. And as you had mentioned, CDs, the bank can actually have longer-term CDs as well, certificates of deposits that will give you more interest the longer you risk your money. So that's the second component, which is the time. And then the third component is really what can the institution that you're investing your money with, what can they do with it, right? Because that's going to be a lot of the risk as well. So if I put my money into the stock market, for example, then what that means is I'm actually buying into a company, and that company can use that money essentially to generate value within their business. I'm buying a share of stock. If I'm buying a bond, I'm really giving the company a loan. I'm loaning them the money to do whatever it is that they need to do with that money, just like if you were to take out a loan. And so the risk there is pretty high depending on what the covenants of that bond allow them to do with the money. Are they buying real estate? Are they building a manufacturing plant? Are they building equipment? It's really going to depend on what type of bond it is. And then inside of a certificate of deposit or a savings account, there are limitations that the bank can actually use that money for, going back to the time as well. So the amount of things that they can do with the money are also the amount of risk that's going to be imposed on that money that's going to determine the interest rate. So I think for these individuals, as you had mentioned, it doesn't sound like a huge interest rate for them to get if they keep it in their savings account. But I would also question if they were to put it in a 1-year CD, what the difference is for them to take that risk on. And you have to think about what you're willing to give up in order to get that greater return. And the one thing when you are buying a house that's really important is the liquidity risk, right? The risk that when you need the money, it's not available to you. That would be the worst. I'm ready to buy the house. I got to put my down payment down. And then all of a sudden I go to collect it from the bank and they don't have it. Or the principal value is less than what I gave them at that moment in time. And so you can use instruments like the savings account, or that's FDIC insured, or a CD, or a treasury bond that can help prevent losing the principal. But when you go into riskier things such as a bond or a bond fund or a stock or something that's going to have a lot higher return, then what you're risking really is the opportunity that you won't get that liquidity back, the principal, when you need liquidity on that particular investment. So yeah, this is a tricky one. I mean, I think we all want more interest, but how do you get it? What are you willing to risk?
I think we talked about that on last week's episode. Somebody was a similar question about the stock market and outperforming returns. Everybody wants a bigger return, right? That I don't think there's a single person out there with a lump sum of cash that's not trying to maximize the amount of money that they're going to get on that. But like you said, around liquidity, sometimes it just makes sense for that peace of mind for you to have that money ready and available. Just trying to maximize, pinch in here and pinch in there just to get a little bit ahead. Is all of that work ultimately going to be worth it if you don't have access to the cash? So you're talking long-term, 20, 30 years planning for retirement. Yeah, it makes sense to make some bigger financial moves. But here over the next couple of months, it may just be smarter to look up a bank with the higher savings account interest rate. If that's out there, do some research and see if there's something that can take your $20,000 lump sum, doesn't have a minimum deposit above that or something, can give you a higher return, and just let it sit. Have the peace of mind that you have access to that money tomorrow, or who knows, your plans may change as well. Like buying a house a year from now,
that's right,
may change if you get a windfall from a relative or something over the holidays, or or you lose your job, or you get a promotion. All your plans in the financial world are always going to be changing. So you do your best to project, but I think in this case, I would probably keep that money just in a savings account, let it simmer, and just try and maximize it the best I can. Let it be there. Just
make sure that it's going to be there. Don't put it under your mattress.
Right.
Because it's really liquid under your mattress, but it could be really liquid for somebody else who breaks into your house and takes your money.
I have a funny story about that, actually.
Oh, really?
Yeah. So both of my parents are immigrants, and when they first moved to the U.S., I can't remember if it was because of the structure of their green card or the status of their visa. For one reason or another, they weren't able to open up a bank account, and so they were getting paid every week, and they would take their checks and cash them out. They'd pay their bills, and then they just had all of this cash. And so they ended up sitting on thousands and thousands and thousands of dollars in cash that they kept under the mattress. And then when they finally had enough, they decided they were going to buy a house. They were done renting an apartment. They were going to buy a house, and they walked into the bank, and they had tens of thousands of dollars in cash.
Wow.
I think my mom kept it in her purse or something, and they walked into the bank.
Oh, wow.
And the bank manager's head nearly exploded. He was like, "You can't just walk into the bank with $75,000 in cash."
Right. Where did you get this money? We need to file an IRS form.
Right. So they had to open an account and then delay their buying of a house a couple months so that every week they could go and deposit whatever the limit was and get it into the bank in the real way until they finally had enough money. Lessons learned. They didn't know that. They were like, "We have the money. We want to buy a house. Why can't we?"
It's not the safest way. But let's take that example, though. I mean, if you do have a large amount of money and you have a longer time horizon, there are a lot of cash management strategies that you can do. Many businesses do this, whether it's a construction project that has money that has to be paid out over time, or you're trying to have a certain amount of money set aside for payroll expenses or for equipment that you're purchasing. There are instruments out there that you can use to do what's called a laddering effect, right? And so one of the things that you can do is that you can buy, let's say, a 3-month CD, and then you can buy a 6-month CD, and then you can buy a 1-year CD, and then you can buy let's say a 3-year CD, and then you could buy a 5-year CD. And so you buy all of those CDs at the exact same time, a 1, 3, 5, all the way to the maturity that you're trying to get to. And then what happens is that it gives you liquidity early on. So that 3-month CD is going to come up in 3 months. But when you don't need the money, what you do is you turn around and you buy a 5-year CD. You buy the longest maturity that you had, from the original date. And so what ends up happening is every 3 months, every latter point of the CD is going to come due, and you're going to get liquidity. But if you don't need the money, you can just continue to buy the longest term CD that you need. And then ultimately what you have is that you have a bundle of longest maturity CDs. So it gives you liquidity up front. Because if I needed the liquidity, I'm going to having cash coming due in a regular cycles, because I bought the 3-month, the 6-month, the 1-year CDs. But then when I don't need the money and that money comes due, I buy the longer term, and so then I get the better interest rate for the longer term. And so you can do a laddering effects. There are institutional bond funds out there that you can buy that kind of have a very steady NAV or net asset value that keep it at the original principal value that you had invested in. But they're going to have limits, like you need to have at least $50,000 or $100,000 in order for you to be able to participate in some of those things. But the interest rate's going to be a lot better than what you could get traditionally. So lots of different strategies out there. Definitely make sure that you are aware of the time horizon you have when you need the money, the fact that you can or cannot risk the principal. That's going to be very important. Going back to what can these people use your money for, and then the amount of money. How much money are you tying up? All those are tying into what that interest rate is ultimately going to give you.